Hey everyone, today we are diving into a huge topic in retirement planning, maybe the topic. How do you guarantee you won't outlive your money? And to do that, we're going to pull back the curtain on one of the most powerful and, let's be honest, most confusing tools out there, the life annuity.
You know, this is the question that keeps people up at night, right? The fear of running out of money is very, very real. It's the central problem we're all trying to solve when we think about retirement income.
So, to make sense of all this, here's our game plan. First, what does a paycheck for life actually mean? Then we'll look at 5 totally different ways to get that income. After that, we'll see how you can tweak your payout, and then ask the really big question, is an annuity even a good fit for you? And finally, if it is, we'll talk about how to buy one the smart way.
All right, let's jump right in. At its heart, a life annuity is just one tool, one potential solution to create a reliable, predictable income stream from the money you've saved up. Think of it like building your own pension.
So what is this thing, really? Well, it's pretty straightforward. A life annuity is a deal you make with an insurance company. You hand them a chunk of your savings, and in exchange, they promise to mail you a check every single month for the rest of your life, no matter how long you live. That's why the best analogy, really, is that you are literally creating your own personal pension.
And this is probably the most important word you'll see today, irrevocable. This is the catch. The moment you flip that switch and turn your pile of money into an income stream, that's called annuitization. Well, for most of these contracts, there's no going back. You can't call up and say, hey, I changed my mind, can I have my lump sum back? It's a major, major commitment.
Okay, so because it's such a big commitment, you've got options. This is not a one-size-fits-all kind of deal. There are a few different ways to set these up, and we're going to look at them as 5 distinct paths you can take, depending on what you're trying to accomplish.
Path number 1 is the simplest, the most direct. It's the Single Premium Immediate Annuity, or SPIA. And it does exactly what it says on the tin. You give them a single premium, a single payment, and your income starts, well, immediately, usually within a year. It's clean, it's predictable, and it usually gives you the highest possible starting payout. But what's the trade-off? You guessed it. You give up control of that principal for good.
Path 2 is for all you planners out there. A deferred income annuity, or DIA, is where you buy your future retirement income today, but at a discount. You pay the premium now, but the checks don't start for maybe 10, 15, or 20 years. It's a great way to solve for that "what if I live to 95" problem. The downside, of course, is that your money is locked up for that whole deferral period.
Now, Path 3 is a really interesting one. It's kind of the modern, flexible approach. It's a fixed indexed annuity, an FIA, with a special feature added on called a guaranteed lifetime withdrawal benefit. I know, that is a mouthful. But here's the key. It gives you lifetime income without forcing you to make that permanent, irrevocable decision. You still have access to your account value, and whatever's left when you pass away can go to your kids. The trade-off? The income might start a bit lower than a SPIA, and you're paying a fee for all that flexibility.
And then there are 2 more specialized paths just to be aware of. One is a QLAC. You can think of it as a special deferred annuity that's designed to work with your IRA funds. It's a tool to help manage taxes and those pesky required minimum distributions later in life. The other is a variable annuity with an income benefit. This one is for people who want their money to stay invested in the market. The big caveat here is that it definitely comes with higher fees and, of course, more risk.
So once you've picked your main path, you're not done yet. There's another layer of choices to make, and this is all about how you actually get paid. This is where you have to make a very direct choice. Do you want a bigger personal paycheck, or do you want to leave more behind for your family?
Just look at this breakdown. It's all a trade-off. If you choose life only, you're going to get the highest possible monthly check, but the second you pass away, the payments stop. Cold. Want to make sure your spouse is covered for their life too? Great. You can do that with the joint and survivor option, but your starting payment will be lower. Want to make sure your heirs get back at least what you put in? You can choose a refund feature, but you see the pattern. Your personal payment goes down. Every single guarantee you add for someone else reduces your income today.
Okay, so with all these choices and trade-offs, how on earth do you know if an annuity is right for you in the first place? Let's get into the nitty-gritty of who this works for and who it absolutely doesn't. So, an annuity might be a fantastic fit if you don't have a traditional pension and you just need that guaranteed paycheck you can't outlive. Or maybe longevity runs in your family and you're genuinely worried about living to 100. It's also great if you just want simplicity, no more stressing about market ups and downs. And here's a neat one. It can be a unique tool if you retire early and need income before you turn 59 and a half.
On the flip side, an annuity is probably a bad idea if your number one goal is keeping your money liquid and totally under your control. If leaving a big inheritance is your top priority, or if you think you might need a big chunk of cash for an emergency or an opportunity, then locking up your money in one of these could be a real mistake.
All right, so let's say you've listened to all of this and you're thinking, you know what? This might actually make sense for a piece of my retirement plan. Well, let's get practical. Let's move from theory to a real action plan.
Buying one of these should be a very logical process. Step 1, figure out exactly how much income you need to cover your essential bills. Don't guess. Then, pick the structure that matches your goals. Are you all in on the highest payout with Aspaya, or do you want the flexibility of the FIA with that income rider? Step 3, choose your payout option, that income versus legacy choice. Then, and this is crucial, you've got to compare different insurance companies and only look at ones with strong financial ratings. And finally, you should really work with an independent broker who can shop the whole market for you, not just one company.
And please, whatever you do, try to avoid these really common mistakes. Don't jump in too early and give up your flexibility for no reason. Don't forget about your spouse or your kids when you're picking that payout option. Don't get distracted by some flashy marketing brochure with big numbers. Focus on the contractual guarantees. And again, don't just buy from the first company you talk to. You're just limiting your options.
At the end of the day, it really boils down to this one core conflict. The simple, old-school, immediate annuity will probably give you the biggest possible check starting from day one. But the more modern version, that FIA with the income benefit, it gives you that same promise of lifetime income, but it lets you keep control and preserve a legacy for your family. It's the ultimate trade-off, maximizing your income versus maintaining your flexibility.
And so the final question isn't really for me to answer. It's for you. When you think about your retirement income, what do you value more? Is it the absolute biggest, most ironclad guarantee you can get? Or is it having the control and the flexibility to change course if your life changes down the road? Your answer to that question is what's going to tell you which path is the right one for you. Thanks for tuning in.